Good evening, everyone, and thank you for joining us tonight. I'm Robin Conway, GM of Managed Funds, and I'm joined tonight by Ashley Gardyne, our Chief Investment Officer, Tiffany Yee, one of our Senior Wealth Advisors, and Robbie Urquhart, one of our Senior Portfolio Managers for Australasian Equities. We have had a great selection of questions coming through for this live stream, so thank you to everybody who has sent those through. Ash, we'll start with you. Could you please give us a bit of an update on the key developments in markets over the last few months?
Yeah, there's certainly been a lot going on in markets over the last couple of months, whether it's political, economic, geopolitical, so lots to talk about. And I think this time in April, when we were doing another live stream, essentially, we just had Liberation Day. Markets were in a bit of free fall. And in fact, the US market was the worst performing market in the first 3.5 months of the year. Europe was outperforming. That's actually quite surprisingly changed quite abruptly. The last 3 months, the US has sort of led the market back to all-time highs. That's been driven a bit by some of these big tech companies we hear a lot about. But I think the drivers were a number of different things. The first was simply having a pause on the trade war, essentially, a pause on the deadline for tariffs being put in place. The second one was seeing a bit of progress on negotiations for countries like Japan and the UK that provided the market a bit of positivity as well. But also 3.5 months later, we just haven't seen a massive impact on the economic variable. So unemployment in the US is still very low. The bank CEOs are still talking about the consumer in the US being quite strong, and we haven't seen a pickup in inflation yet, despite all of the concerns. So all of that means that we've essentially had a pretty strong rebound in markets, and most markets around the world are back at all-time highs.
Yeah, okay, great, thank you. Robbie, we have had a lot of questions about what's been happening in the US at the moment, but I wanted to start with closer to home. Are there any signs of rebound in the New Zealand economy yet? And if not, when do you think we might see one?
Well, Robin, we bounced out of recession from an economic standpoint, at the start of this year, helped in part because we've had a recovery in the rural or primary sector. But overall, the broader New Zealand economy is struggling quite a lot. So if we look across a range of different industries that are key to our economic growth, they're really doing it tough. Main Freight called out, which is one of the large logistics companies, they called out that they're seeing their customers trading down because they're finding things tough. In construction and the building segment, Fletcher Building has called out how property settlements are down. The sales volumes from a volume perspective, those are down for key commodities that they sell, including steel and concrete and cement. Vulcan Steel, which is a pretty good steel distributor, they've echoed similar comments, and they've pushed out a recovery that they hope they'd see this half out into next year at the earliest. And then if you go into the discretionary part of the economy, Briscoes, which is a really good retailer, they've called out that they find retail conditions have remained tough, leading to the back end of the end of this first half that we've just gone through, and they expect retail conditions to be tough through the rest of this calendar year. So overall, the economy, although it's growing, large parts of it are really struggling.
Yeah, and there's definitely a lot of toughness going on out there at the moment. Now, Ash, if we just jump back to you, we've got a question about US debt levels. It says the USA is ignoring the unsustainable increase in national debt and continues to live beyond its means. What are the longer term implications of this for investing in in US shares, and how is this risk managed in portfolios?
Yeah, there's certainly been a lot of talk in markets in the last couple of months around US debt levels. And one of the reasons for that is people that are listening in might have heard about Trump's term, the big, beautiful bill. So there's been this big bill passing through Congress, essentially trying to fulfill some of Trump's election promises, one of which was to extend his 2017 tax cuts. But also some additional things like removing taxes on tips and overtime, but also boosting spending for border security and defence and a range of other things. So as a result of that, the US deficit over the next 10 years is expected to be about $3 trillion higher than initially expected. And that comes at a time when the US debt levels are about 100% of GDP, which is sort of where they got to after World War II. So there's definitely some question marks there. To put that in a bit of context, though, we have similar levels of debts to GDP in places like Canada, France, the UK, Italy, so it's certainly not unprecedented. Japan has a lot higher debt than that still, and markets aren't overly concerned by the levels of debt yet. But at some point, they're going to have to pay down debt levels, or at least come up with a comprehensive plan for how to make sure debt levels don't continue moving up from here. But often you don't see governments make those tough decisions and talk about things like austerity until markets sort of force their hand, but we still think it's some way off.
Yeah, okay, good to know, thank you. Tiffany, as a retiree relying on a KiwiSaver to top up the super for the next 20 years, is this a time to stick to a conservative-based portfolio or consider a more growth-based investment?
Thanks, Robin. So as a retiree, you rely on KiwiSaver, that kind of puts you on the conservative side. But in the meantime, I hear that you want to rely on KiwiSaver for 20 years. When we talk about long-term investment, we typically mean 7 to 10 years. And 20 years, that's a very long duration. That's long enough for you to ride out the ups and downs in the market. And that will put you on the growth side. So I completely understand why you feel like confused, not sure you should go with conservative or growth. The KiwiSaver strategy is not just based on your age or your time frame. It also comes down to your plans. What you plan to do with KiwiSaver. We know your long-term goals is to keep KiwiSaver to top up the pension, but have you got any short-term plans? Going for a holiday or need KiwiSaver to buy a new car or kitchen renovation? That's all counts. And also it comes down to your comfort level. When you think KiwiSaver balances drop, can you sleep well at night? Right, that matters as well. So it's everyone's situation is different. It's really hard to there's no one answers for everyone. So I'd say the best thing to do is to talk to a financial advisor so we can go through the proper financial advice process to find out what's your short-term goals, what's your long-term goals, and your time frame and your comfort level to get personalized advice.
Yeah, fantastic. Thank you. Robbie, perhaps linked to the earlier question on the New Zealand economy, what do you see as the next move for the official cash rate in New Zealand?
Yeah, Robin, I think the Reserve Bank of New Zealand, or the RBNZ, will cut interest rates and reduce them and provide borrowers with relief at the next meeting that they have in August. So it's currently at 3.25%. Suspect that they're likely to cut to 3% at that August meeting. But the decision is not a slam dunk. And the reason it's not a slam dunk is because although the economy is struggling, in large parts of the economy is struggling, the sole mandate for the RBNZ is to focus on price stability, which means keeping inflation in that 1 to 3% band. And they've got to do that over, with a medium-term focus. And what we've seen is that although the high levels of inflation that we saw coming out of COVID have subsided and have started to retrace and are back inside that band, they're still sitting towards the top end of that 1 to 3% range. So the inflation figure that was released yesterday in New Zealand pointed to the last quarter having a CPI rate or inflation rate of 2.7%. So it's uncomfortably close to that top end of that 1 to 3% band. And there are a number of measures, core measures in there that are proving to be quite stubborn. If you think of food inflation or power, electricity prices, those have been sort of above that 3% level. Now, the other side of that, though, is that one, at least, firstly, at least that 2.7% level is sitting within the band. Secondly, although, non-discretionary items like food and power, those inflation rates have been higher, those are non-discretionary, so they're unlikely to result in consumers changing their behavior much. And they draw income from non-discretionary sectors, that consumers would otherwise spend on. Which means that with, the economy sort of, chugging along at quite a sluggish pace and a lot of, discretionary parts of the economy struggling, the RBNZ is likely to take that kind of slack into account when they think about where the inflationary pressures will go to from here. And there were other core measures of inflation outside of, food and power that were, flattish or slightly negative as well. And the RBNZ would have taken a lot of comfort from that. So if you put all of that into the pot, I think we'll see them cutting, and I think that will be a welcome relief for a lot of people in New Zealand.
Yeah, absolutely. Thank you. Ash, what's next in the tariff war, and how do we think that might impact markets?
Yeah, so actually a week or two ago now, we were supposed to have a bit of a a bit of a sort of final point around the trade war in terms of a landing on some of these tariff levels. That was the 9th of July, but actually Trump's pushed that out to the 1st of August. So there has been a delay there, which has given everyone a bit of sort of pause to think about tariff settings essentially and trying to get some negotiations going before the 1st of August. So that's given some breathing room. On the other side, though, that 1st of August deadline is in focus, and Trump has actually ratcheted up the tension a little bit by putting a bit of pressure on a range of different nations by saying if we don't get an agreement by the 1st of August, 25% tariffs will apply. So we're back into this world of sort of back and forth. But what we have seen is that there's clearly a willingness to negotiate and willingness to push deadlines out if it looks like it's going to hit the share market or the economy, which I think is a really positive thing. I think the other thing that we've learned over the last few months is that the initial knee-jerk reaction probably wasn't the right one, but from economists and from investors and from everyone essentially, as we've had more time to sort of digest and see how this might impact the real economy, we've sort of seen how it's flowing through at the moment. There hasn't been a huge impact, and people have been able to come up with some scenarios around how where tariffs might end up. And economists expect in the US, as an average, tariffs might get to 15 or 16%, which probably means you have 10% tariffs on a range of different countries, maybe higher on China, and then higher on selected goods like pharmaceuticals or copper or aluminium. But weighing all that through, the expectation is that could it lift CPI inflation by about 1%, and it could impact economic growth by perhaps 2% over a couple of years. So overall, with a bit more time to think about things and really factor it all in, it looks like the economic impact might not be as big as people initially thought.
Okay, good. Thank you. Tiffany, we've got quite a long-term question here about someone wanting to put money away for the future of their 5-year-old. But the question is if now is a good time to start, or if with all the uncertainty going on, and particularly coming out of the US, is it better to wait?
Thanks, Robin. That's a great question. That's the question we want to hear. So first, when you think about setting up an investment for a child, you're already getting started. I'm a mom. My daughter's turning 3 in 2 months' time, and I set up the investment account for her just after she was born. At the time, that was just after COVID, and then we went through a lot of things, and the tariffs and the wars and the account balances went ups and downs, but I'm still feel so glad I've started at the right time. If you try to wait for the perfect time, there's never be a perfect moment. The truth is, every couple of years or couple of months, you will see something in the news and the share prices goes ups and downs. But when you want to set up an investment for your child, they're young. We're investing for their future. That means we have a solid 10 or 15 or 20 years to invest. That give you enough time frame to ride out the ups and downs. So rather than waiting for the perfect moment, why not just start now? That's the most important thing. And the message I really want to send to the parents or grandparents, if you do want to set up an account for your child and investing for their future, just start now, because nothing should stop you from what you wanted to do. And any small steps we're making today that will make a big impact for their future.
Yeah, thank you. And I think time and market is obviously one of the most important factors there. So grateful for that.
Absolutely.
Tiffany. Robbie, we've got a question about AI. Agentic AI is set to rapidly change customer experience and business productivity. What sort of impact could this have on our funds?
Yeah, well, AI is all the rage at the moment. Stands for artificial intelligence, and it's clearly going to have a huge disruptive impact. Technological innovation like that tends to come with both opportunities as well as disruptive risks that businesses across the spectrum will need to think about. From a portfolio perspective, if we think of our different funds, we can sort of bucket the companies we invest in through three different lenses. The first is we're seeking to invest in companies that will be beneficiaries of this AI revolution. If you think of companies like Microsoft and Meta, they're sort of at the forefront of that, and they sit within our international portfolios. Then there will be a whole swath of companies across a range of industries that will be impacted by AI probably, but the exact mechanism of that and what that looks like, we don't yet know. So there, we just focused on speaking to these companies and ensuring that they're doing what they can to be protected against AI being a threat, and hopefully benefiting them if they embed AI processes within the way that they do business. And one example that I'll highlight there for you is Seek, which is an Australian listed recruitment company. It's it has websites across Southeast Asia as well as Australia and New Zealand, and the way recruitment is done, and the way people advertise and put themselves out to for new jobs, and the way hirers seek to get in touch with talented people, that's going to be clearly disrupted by AI. And we went across to Seek's Investor Day recently over in Melbourne, and what was pleasing from our perspective is that a good chunk of the day was devoted to how they're going to harness AI and protect their business from the potential for AI to disrupt their business operations. So in that lens, in that second bucket, we're just trying to find how management teams are, making themselves AI resilient, to protect against the disruption that will be coming down the pike. And in the third lens that we look at companies through is to find businesses that are probably going to be AI proof. And again, just speaking to the Australian portfolios, because those are the ones that I'm most familiar with, we're recently invested in a construction materials business called Mast Group. And they have, the key part of their business is a whole bunch of quarries up and down the east coast of Australia. And they crush rocks, and that goes into aggregate, which goes into concrete and goes into making of roads, and goes into infrastructure projects. And regardless of how good AI chatbots get, at the end of the day, it's going to be a long while yet before robots can go in and crush the rock and shift it to, shift the aggregate to sites. And even when you get to that point, the key asset that a company like Mast has is the actual quarries themselves. And AI can't manufacture rocks and aggregates out of fresh air. So we feel quite happy. There are lots of things we like about that business, but from an AI perspective, finding companies like that are AI proof is also part of the puzzle. So overall, it remains to be seen how AI will wash through different businesses and how that will directly impact the funds that we're investing in. But we are, very focused on that as an investment team and looking for ways in which we can hopefully benefit from the AI revolution.
Yeah, great. Thank you. Ash, Trump's talk about tariffs hit my savings in April. He's now passed a bill that mainly benefits billionaires and raises debt levels. What might his plans be from here, and is it worth staying invested?
It's definitely hard picking what the plans might be from here, but I think it is really interesting thinking about politics and investing. I think it is important to keep them quite separate, and we've seen lots of examples of this through time. There's a lot of political noise out there at the moment. It's quite polarizing, but I do remember back to Brexit, for example, was really interesting, or even Trump's first term. There was sort of certainty that if Brexit happened or if Trump was elected, markets would fall, and actually the opposite happened. And it's not necessarily because those things benefited markets. It's often because there are lots of different factors impacting markets. It's the economy, it's interest rates, it's inflation, it's sectorial trends, it's technological advancements. So there are lots of different things that go into drivers of a share market, not just policy. So I think that's really important to remember. Also, if you look through history in the US, the last 100 years or so, we've seen very similar returns in the share market, regardless of whether it's been a Republican-led or Democrat-led parliament. So I think government, so that's really important as well. And even looking back at the last Trump term, it's quite interesting because we had 3 10% drops in the market over that 4-year period. So it was quite a volatile period. The first drop was partly because of the US-China trade war, but that was the only politically driven drop. The next one was because the Federal Reserve hiked interest rates quite significantly, and the third was a 20% drop, was COVID, which was completely unpredictable. So it's often not politics that has the biggest impact on markets. It can be completely different things. And I think back to the question, if they're planning to sit out of markets for the next 3 years until there's a new president, there's a risk that you miss out on a lot of gains. And actually over that last Trump term, markets are up about 80%. So you do have to be careful sitting out of markets for long periods of time because of political reasons.
Yeah, absolutely. Thank you. Tiffany, we've got an age-old question about property. Over the past 20 years, which investment strategy has delivered better results, property or shares? What are your predictions going forward?
Thanks, Robin. That sounds like classic debate, properties or shares. It depends. For property, what type of property are we talking about? Commercial or residential? When did you buy? And that matters as well. If you bought one 20 years ago and you bought one in peak 2021, there will be different results. And where did you buy? Overseas or New Zealand, or even within Auckland, different suburbs had different returns. Even on the same street, if your neighbor sold their property and if made the earning or loss the same amount of money they made doesn't apply to you. And also comes to shares, it also depends on when did you buy and what sector and which company did you buy, because some of them went up significantly and some companies went to zero. So it's really hard to say, but if we look at 20 years, I'd say they're both done well. They're both provided good returns, but you just need to be in the right shares and right property. I feel like I'm comparing apples and oranges, but for a managed fund, what we offer, you can have a fruit salad. It's a diversified portfolio because we have direct property in the KiwiSaver and we have shares in New Zealand, Australia, International, and also for managed fund, we have property fund. Buying a property is not the only way to invest in. You can invest in property in the indirect way by investing in a property fund. So not trying to say managed fund is better. It's more about which one is suitable for you. Owning a property can be hard. It requires a large amount of capital. Shares or managed fund is easy to get in and it's more liquid. If you want a holiday or buy a new car, if you own a property, you can't really sell your kitchen or garage to fund it. So it's all different. And as I said before, everyone's situation is different. And I do think it's quite hard to say which one is better for you. You need to talk to a financial advisor and looking in the future. And I do believe they are both great investment vehicles. That's why we have shares and property in our portfolio. So yeah, give us a call, talk to a financial advisor.
No, thank you. All right, thank you, Ash, Tiffany and Robbie. That does wrap up our questions for tonight. As always, thank you for your time and we hope that you found that useful and we will see you again soon.